Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. In my most recent video, I talked about the fact that the market was crazy overvalued, and I used the S&P 500 as my proxy. And I got to tell you, I got some very interesting comments on that article that was actually an inspiration to do kind of a follow-up video on how much value there actually is out there. Now, a lot of people said they didn't like the S&P 500. They talked about it being overweighted with tech, Microsoft and Apple, for example, being the two primary culprits. Others said I should use, other indices, more broader averages, etc. All that's fine. I have access to the S&P 500, so that's what I use, and it is a good proxy for the market. But here's the real rub to me. This idea that I had several comments where people said, things like, the market's overvalued. What do I do? Should I park money in cash? And other people tried to talk about how it was justified to be paying these high valuations. And then other people said everything that was in value was too risky. And I find all of those really a whole bunch of opinion and not a whole lot of fact. And so what I thought I would do today is go through a video where I actually show you how I search for value, because in several of the comments I made the comment, no, don't sit in cash. No, don't, bury your head in the sand. Look for value, because in all markets, whether it's a bull market or a bear market, there's always value to be found. Now, in a raging bull market, it's going to be harder to find value than in a bear market. Warren Buffett once, famously said, be greedy when others are fearful and fearful when others are greedy. But the corollary to that is there's always value to be found. It is a market of stocks and not a stock market, as I say so many times. And the reality is stocks are different. They come in all different sizes, shapes, flavors, configurations, growth rates, risk levels, etc. So what I'm always doing is I'm looking for value wherever I can find it. So let's go ahead and kind of get an overview of the market, and then I'm going to show you where I have been finding value in this market. And I think that might be an eye-opener for many of you. I did start out with the S&P 500 here, and I have two valuation reference lines in this graph. I have the normal fair value for the market of around 15. Famously, Ben Graham said, don't ever pay more than 15. Or I think other time he said 16 times earnings. The key is that's an earnings yield of 6.5% to 7%. So that's kind of always my minimum threshold. But it's not just about earnings yield. There's other things that come into value, such as growth. Okay, so you want to buy good value at a reasonable growth rate, but you can use these rule of thumbs as guidelines to kind of keep you centered and help you make good decisions. Well, clearly, the S&P 500 at a PE of 27 is significantly overvalued. Now, then I got the argument that, yeah, but it's overweighted by names like, Microsoft and Apple and Google and so on. And there's truth to that. There is truth to that. But the point that I think was missed there, the vast majority of the S&P 500 is overvalued. Now, I'm going to just use my earnings yield of 6.5% to 7% as kind of a threshold here. So what I'm going to do, I'm going to go through this in chunks. Now, there's over 500 stocks in this index. This is the S&P 500. All right, so let me collapse this so you can see that easier. All right, so I'm looking to where my earnings yield doesn't exceed 6.5% to 7%. But there's obviously another issue here. You'll see there's a lot of things like you'll see a lot of financials show up and some healthcare companies show up in this little process I'm going to go through here, because there is a lot of value in those two sectors. Here's Prudential and MetLife, which I've recently been asked to cover. I'll be covering those in the future. There's Unum in the financials. There's Viatris, which was the spinoff, which is extremely inexpensive. But watch I go through this. These are 10 companies at a time. So there's 10, 20. I still have a lot of financials and healthcare. 30. I still have financials, and now I've got some consumer staples and materials, companies like Altria, which is obviously tobacco. So there's 30. I'm going to go 40. I'm still at over 6.5% to 7%. I'm going to go 50. I'm still 6.5% to 7%. There's Kroger, which I covered recently. There's Cigna in healthcare. There's Edison International, a utility. Western Union, Tyson Foods, which I recently covered. So, here now I'm at 60. I'm still over 7%. Now I've got 70 companies out of the 500. I'm still over 7%. I'm going to go on. I've got 80 companies out of the 500. I'm still, significantly heavily weighted in healthcare and financials, as you can see here. But I've got Best Buy, and I've got an industrial here with Huntington, Ingalls, et cetera. I got Alexon Pharmaceuticals and healthcare. So here's 90 out of 500, and I'm still at 6.5% to 7% or above that. Now I'm hitting 100. So I've gone through roughly 20. And this kind of gets to be where it stops. I'm at 6.65% with Newell Brands. Now keep in mind, these are all good companies, most of them that you could buy. Some of them I would reject for a lot of other reasons. But the point is, I do have some valuations here that aren't just crazy like I showed you when I showed you the index utilizing the fast graph. So now I get over 100, and now I'm starting to miss, I'm getting below the 6.5% threshold that I'm looking for. And I go a little further and I'm a little further behind. And now all of a sudden, I'm down to 6%, but I still have financials and healthcare. I'm seeing a lot of energy stocks in this as well. I go down, now I'm at well below 6% here, and I've still got quite a few names to go. And I'll go ahead and open this up here for you and just show you what, rather than just bore you with this and just go through this thing as quickly. You can see once I get below the 6.5 to 7%, there are lots of overvalued stocks in the S&P. It's not just Apple and Google and Microsoft, etc. There's lots and lots of companies. And, I'm going through this quickly, and I've covered a lot of these names. There's Apple that have earnings yields that are just ridiculously low, 2 and 3%. You own the whole company, they pay you all their profits, and you make 3%. That's what this is saying. So the point is, there's a lot of stocks in the S&P 500 that are overvalued, as I pointed out, but there's also about 80 to 100 or 110 or so that are reasonably valued that might actually be places where you could start looking. But then I went on and I went and looked at other indices, if you will, or sectors, and I looked at the S&P 400 mid-cap. Now, the mid-cap sector is very interesting to me, and I'm going to focus on mid-cap here because I think that's where you find the most value, but you also have some really neat opportunities for growth. But keep in mind, I'm looking for value plus growth. Just because a company has a low PE ratio or a high earnings yield doesn't automatically make it a good investment. Like, for example, here I've got a company with a PE of 7.5, but it's estimated to shrink by almost 19% over the next year or two, and the long-time trend line growth is expected to be worse. So there may be current value there, but there's not any future value there. So I would ignore that kind of company. But once again, as I go through this and I'm focusing on this earnings yield column here, you can see that I've got lots of choices in the mid-cap sector of companies that I can look at. Once again, I've got a lot of financials, as I mentioned, in the big one, but I've got healthcare in here. I do have some tech stocks in this regard as well. I've got some materials. So the point is, it is a market of stocks, not a stock market. And that's really what I'm trying to get across here. So going down further, I put together a list of companies that I would be interested in possibly buying that are mid-cap stocks. And it would depend on your investment objectives and what you're looking for. Because, for example, let me add a column here on this particular thing. I'm going to add dividend yield. Okay, if you're an income investor and looking for dividend yield, you're going to find the mid caps aren't all going to be paying dividends. So here, if I look at it from this point of view, I've got several companies here that are paying dividends. I've only got 14 companies on this list, and I've got about half of them here are paying dividends. And there's going to be some here that I'm going to feature and pick out, but there's a lot of them that don't pay dividends. All right. And I've got, companies like Jazz Pharmaceutical, which I've been asked to cover in the past. Jazz is a good growth pharmaceutical company with a pretty good track record. And, it has some really strong growth here. I'm going to narrow this down so I can give you some growth numbers on this because you've got some crazy numbers here. It's been growing at over 20% a year. Its normal valuation has only been about 12 times earnings, which is interesting. So if I'm looking at it here at a 12 multiple, it might be a tad overpriced, but it still would give us decent rates of return. Long-term growth for this particular company is over 14%. But again, if I use that 12 multiple, I'd have 11 or 12% potential rates of return that I could get investing in a stock like Jazz. All right, but there are certain companies here that I picked out that I do want to go over and show you that I think are very interesting. One of them is Jabil Inc., and I've covered this one before. First of all, it's BBB-. It's got good valuation. It's got tremendous growth potential. It's an electronic manufacturing services. This company does business with some of the major tech companies on the planet. It's also involved in several sectors. It offers products for healthcare supplies, healthcare equipment, as well as in the technology sector, et cetera. So it's a really interesting company. Long term, you can see it's moderately cyclical, but if I look at it in recent years here, you can see that the company's generated really good growth. The market likes to trade it at around a 10 or 11 multiple. I'm going to take one more year off there for you. We've got 15% growth here. The company's forecast to have a really good year this year and then slow down a little bit going forward. But that's still, even at a 15 multiple, that would give you the opportunity to make very substantial rates of return going forward. At a 12 multiple, or you still have double-digit rates of return here. So there is value to be found, but there's not a lot of dividend yield. The dividend, as I mentioned, is it's less than 0.5%. But some of these stocks do offer you good dividends. So let's look at something that does offer us some decent dividend yield. I'm going to take a look at Dick's because this is a very interesting story to talk about. Dick's was a company, obviously, that suffered dramatically from COVID. We all know what happened during COVID and so on. And the stock price, I shouldn't say the company, I should say the stock price fell precipitously during COVID. But Dick's actually did real well. They did really well with online sales. And the company was able to basically get through COVID. They increased their dividend each year. Look at the growth that they have now. Now, there's going to be a lull in that growth coming up. But what I really wanted to show you here, you can buy this stock with a 1.5% dividend yield close. It's a blended PE of 13.8, an earnings yield of 7%, 7.23% to be precise. But here's what I wanted you to see about valuation. I chose this example for this reason. People talk about them being risk. I'm telling you, when valuations are low, risk is mitigated dramatically. Now, Dick's got very undervalued, back in 2018, 19, and 20 with the advent of Amazon and blah, blah, blah. We all know the death of retail and the death of brick and mortar, which has been greatly exaggerated. Then, of course, COVID came and it got hit really hard. But look at the recovery. When you get value like this, undervalued stocks tend to recover, and because the market is always seeking value. Look at the long-term history of Dick's here. Look how many times it got overvalued and came back to value, got undervalued, came back to value, so on and so forth. Where the business goes is where the stock price goes. It created a tremendous buying opportunity here during COVID. And just look at the recovery here. From the bottom of COVID to recently, you could have made over 300% on your money, and you did it with fundamentals supporting you. That's the key. You also did it with the dividend increasing each year. I do want to make that clear. Their dividend, once they started, growing their dividend, it increased by 10%. It went right through COVID. They increased it by over 30%. The payout ratio is still in the 25-30% range max, 15 to 20% normally. So you've got a really interesting company here with great long-term performance. And look how the performance mirrors the actual earnings growth of the company, averaging over 18% a year compared to the market. Now, people are telling me there's more risk where there's value. I don't necessarily believe it. I believe one of the best mitigators of risk is lower valuation. Nothing can protect you against risk probably any better than that, in my opinion. So there's an awful lot of really good stocks out here. This company has, 46% debt. One thing I like to look at when I'm looking at companies like this is their cash flows to make sure the dividend is being covered. And of course, what you see here with Dick's is you see that the operating cash flows are dramatically covering the dividend. I think that's really important. And I think that's really, great. I love to see that. I like to see companies that have good cash flows that are supporting the dividend. And, Dick's is one that was much maligned, but yet what a terrific investment it's actually turned out to be here. The next company I want to look at is Sprouts Farmers Market. Sprouts is a food retailer, obviously, very, very up-and-coming grocery chain, tremendous historical growth. Look at averaging over 30% a year, since they've actually gone public. They went public in August of 2013. But there's several lessons here about valuation that I think are so important. This came out with a lot of hype and a lot of promise, and the valuation that the market originally put on it was very high. Once it came out of the IPO, the stock went, with by the way, 100 PE, 100 plus PE. The stock went from roughly 37 up to 46 in just a matter of weeks. But then look at this. When the fundamentals did not support the valuation, it became undervalued here. More recently, then COVID came along, of course, and then the stock became tremendously undervalued, which is where I believe it sits today. If I look at this stock going forward, the growth rate is not expected to be very strong, but you do have good value here. The longer-term growth rate, however, is expected to be about 15 or 16%. So what I like to do is I like to combine these two to try to give me a perspective. And so I might have a little bit of weakness here over the next year or two, but long term, this little, food retailer is expected to grow dramatically, and it could generate very, very strong rates of return. It doesn't have a credit rating. It does have a little bit of debt, but I believe it's a good quality company. And, you can buy it right now at a very attractive valuation. The PE is only 12, earnings yield's over 8%, but it doesn't pay a dividend. So that's one of the downsides here. This would be more growth oriented. Here's another very interesting growth opportunity I want to share with you is Builders Firstsource. Now, one thing, because I've been asked, and I'll be doing a video in the future here on home builders, you got to watch what's going on. Mortgage rates and application have fallen dramatically, and we all know what happened to lumber prices and so on. But Builders Firstsource here is a very interesting company. It's actually was built between the merger between Builders Firstsource and BMC. Okay, the companies merged. They got 550 locations. As you see, they're going on their website. But look at the growth and look how inexpensive the stock got. When you can find value like this, when you can find companies that are trading at extremely low values, if you're patient, you're going to do well because look how the price has moved back into alignment with the company's earnings growth. Going forward now, I do want to make a point here. You do have to worry about what's going to happen in 2022. A lot of people expect, a lot of analysts, I should say, expect a negative growth rate that year before earnings growth resumes back up into the double-digit rates. And so when I, put the two together here, you can see there's a lot of long-term potential here, but you have to watch that, and you have to watch these home builders as well. So there's an awful lot of good value to be found out here when looking around these mid-cap stocks. The S&P 500 is full of very highly valued stocks. The mid-cap stocks, on the other hand, the S&P 400, for example, there's all kind of stocks. Now, again, I could do a whole article on nothing but financials. I mean, you could just buy, there's financial after financial after financial. Regional banks, life and health insurance companies, etc., property and casualty insurance companies that are very, very inexpensive. But the bottom line is, you can look beyond those sectors. I've showed you quite a few here in this little video. There's a lot out there if you're willing to look. You have to be willing to look deeper when you get into an overvalued market like this. And the idea that these stocks are highly risky, to me, is false. If you can buy these companies inexpensively enough at low enough valuations, you've mitigated most of that risk. And now you've put yourself in an opportunity to make outsized returns at below average risk. And you just see it over and over again. When stocks are real cheap, you want to be greedy when others are fearful and fearful when others are greedy. There's all kinds of opportunities out here. Here's Chemours, another dividend-paying stock. This was a spinoff from Dow Chemical. It's got really high growth expectations, tremendous opportunity. It's only B+ rated, does have a lot of debt, which is typical, or you see that quite often with spinoffs, but the company also generates a lot of cash. Another excellent choice. So it is a market of stocks, not a stock market. The market itself, if you're looking at the broad market via the S&P 500, may be overvalued. But if you're looking at the mid-caps, they're not. And one thing I'll finally say about mid-caps, if you're looking at these mid-cap stocks, the one thing about them is they're smaller and they have plenty of room to grow. And if you pick and choose carefully, you can do extremely well investing in mid-caps for the long run. But I do agree that they may not have the quality. Now, from a credit rating point of view, you can see there are stocks here that do have investment-grade credit ratings. A lot of them in the mid-cap universe that I'm covering here, using the S&P 400 mid-cap. So you can find a lot of companies with, investment-grade credit ratings, find a lot of companies with good earnings yields, a lot of companies with good, prospects, beyond just financials and the healthcare. Anyway, I hope this just gives you an overall better perspective of what this crazy market looks like. Don't be afraid to look for value in all markets. It's there if you're willing to look. Anyway, I hope you enjoyed this video. If you did, give me a like, give me a thumbs up, ring the bell, subscribe to the channel, etc. I always appreciate you guys. Thanks for watching. I'll be talking to you again real soon.